In today's Money Watch, we are talking about how to build credit. The national average credit score is 715, according to the latest report from FICO. And if you are curious about what goes into these scores and how you can raise yours, listen up. We brought in CBS News business analyst Jill Schlesinger with some insight. Jill, good morning.
Good morning.
That national score seems pretty high, right?
It is actually really good. I know it's down a couple of points from like the absolute highest point, which was, I think, in 2023. But if you go back before COVID, the scores were like 704, 706. Then we saw a huge surge with all that stimulus, and people used their stimulus dollars to pay down debt, and that was really helpful. So you're right. I think 715 is a solid score. It is not something that you like should be, oh, I have to be perfect, but it's good to have a strong credit score. It makes your navigation of the economy a little bit easier.
Elaborate on that a bit. Why is the score so important, and what goes into the number?
Well, when you think about a credit score, what is it measuring? It's your ability to repay a loan. So the reason why a credit score becomes very important is it might determine how much and whether you can get credit, like in a credit card, in an auto loan. It could be about getting a mortgage. And so these are very big parts of people's financial lives. And when you think about what goes into a credit score, the folks at FICO, which is the biggest scoring company, there are other ones, have actually laid it out for us. The most important part of your credit score is your payment history, you paying your bills on time. Then there is the total amount that you owe, the credit, the amount of credit available, and there are some other parts like the length of your credit history. But I can't emphasize enough how important it is to pay your bills on time. That is really the cornerstone of a credit score.
So what score should people be targeting as a good score, right?
Yeah, I mean, look, I think that...
And also, how do you improve your credit score?
Okay, well, obviously paying your bills on time is a really important part. So let's start with that. And then for many people, it's establishing automatic payments, because when you have an automatic payment, you're less likely to miss a payment. When you miss a payment, it really does ding your score. I think the other part of a credit score is people will say, oh, well, you know, I was at the store, they offered me a brand new credit card, and I got a 10% discount. This is bad for your credit score, because part of your credit score is the amount of credit that you have available. So, again, I think just opening up credit is bad. Also, the other idea here is that when you're paying off old credit cards, don't cancel them. Weirdly, canceling a credit card actually is bad for your credit score. So you can throw it into the back of your desk, and that can help you build up your credit score. But, you know...
Or you can freeze it in ice.
I guess
Which I've heard about.
I guess that's another way to think about it. I think that when we talk about credit and what you aspire to, you know, you want to have as strong credit as possible. You know, when you look at the credit industry and you look at this like, oh, it's exceptional if you're 800, you're going to get a good interest rate if you're in the 700s. You're going to get a decent rate. But below that, when you're below 700, in the 600s, you are going to actually end up paying more interest on a lot of your loans, and you may not even get a loan. So this is why we emphasize really paying attention to that score.
There's so much mixed messaging about whether you should use credit cards to build your credit or use debit cards so that you don't owe as much money, or buy now, pay later loans. What do you recommend? Well,
it is true that when you use a debit card, it does not contribute to your credit history. So it's good in that you're absolutely right. You know, it is, there you are, you're able to just pull the money from your account. A credit card and a buy now, pay later loan will actually allow you to establish that credit score. If you're worried about it, you can use a secured credit card, which is kind of a hybrid product. It's just a maximum limit on a card.
I've learned something new every time with you, Jill. Thank you so much, as always.
We want to show you why the Federal Reserve is important. President Trump on Friday announced Kevin Warsh as his nominee to lead the central bank after current Fed Chairman Jerome Powell. His term is going to end in May. Warsh is a financier, a bank executive who was a member of the Fed's Board of Governors during the 2008 financial crisis. Now, the Senate, of course, will still need to confirm him, but Warsh's nomination follows the Fed's decision to hold interest rates steady this month. So I'm so happy to say that CBS News business analyst Jill Schlesinger is here to explain what that means and just the whole piece of what the Fed does. So let's start. with the decision, right? I mean, this was expected that they were going to hold it steady.
Yes.
What does that mean?
I mean, it means that if you are a borrower and you've got a credit card balance, or you're going out to get an auto loan, or you've got a personal loan, it's still very expensive. I mean, credit card interest rates for those balances, they're averaging over 19%. That means that a lot of people are paying in the 20s. Auto loans, really expensive. It depends on your credit score. If you have a shaky credit score, you could pay in the teens, 14, 15, 16% for an auto loan. So when we say that the Fed has not lowered interest rates, it really does directly impact people. Now, the good news is if you are a saver, if you're lucky enough to have some money in the bank or a high-yield savings account.
This is good news for you.
It's great. You're saying, oh, I can get a nice, juicy CD. Maybe it's 3.5% or 4%. But, you know, as much as our eyes all glaze over when we say the words Federal Reserve, it really impacts every single one of us.
Well, you and I, our eyes never glaze over because we nerd out about this stuff. I do want to hit on mortgage rates quickly, though, because I think people say, oh, if the Fed moves or stays, does that mean that my mortgage rate that I want to get for my house is going to be better?
Well, the problem with the Fed is they control short-term interest rates, whereas mortgages are based on longer-term bond yields and interest rates there. Now, look, if you go back a year and we say, hey, 30-year fixed-rate mortgages, they were averaging around 7%. Now they're around 6%. So the idea that the Fed was lowering interest rates throughout last year did help bring down mortgage interest rates. But it's not tick for tick. It doesn't say, it's not like you get a mortgage, you say, oh, the Fed lowered interest rates, now my mortgage is 0.25 percentage points lower.
Right.
So the issue around mortgage rates really has to do with the supply and the demand and where people think interest rates and inflation will be in the future.
And because of that, because we know that the Fed is probably going to, stay on a wait-and-see approach, you're likely not going to see mortgage rates move as much because of that sort of where things are going to go.
Yeah, a lot of people have been asking me, should I refinance? What do you think? And it's impossible to know. So I think it's very dangerous to try to guess where the next 1/4 percentage point move is going to come from the Fed. Hey, maybe the Fed is going to lower interest rates. Maybe Governor Warsh, the Fed, when he becomes
if he is confirmed,
that maybe he's going to be the guy to get everybody on board with pushing down interest rates. But he is just one vote. And the voting members of the Federal Reserve each have equal weight. So it's not as if he gets installed and then, poof, he can just make interest rates go down.
Right. That is what the president is hoping, of course, is going to have happen. I do want to get at this question of independence, right? We know that the Fed focuses on inflation, focuses on the job market. We talked about how all of this impacts consumers just now. Why is it so important that the Fed remains independent?
I want to be clear that every president for the more than 100 years that the Federal Reserve has existed likes to pressure the Fed either overtly or covertly, meaning they might go behind the scenes saying, it would be nice if you lowered interest rates. Why is that? Because when you see interest rates go down, it is good for borrowers, and it can kind of juice up the economy. The problem is if there is real pressure on the Federal Reserve to lower interest rates, and that causes inflation to resume higher.
As we've seen in other countries like Argentina.
Yes, and we have seen in other countries like Turkey more recently, that if you see that happen, it's very difficult to get it under control once it starts. So while the president who is seated right now wants lower interest rates, if that causes inflation to rise in a year or 2 years from now, the next president, the next Federal Reserve is going to have to combat those interest rates. And look, we just went through a big inflationary problem. We know how much it hurts. I don't think that Mr. Warsh wants to oversee a Federal Reserve that sees the resumption of higher inflation. So we'll wait and see. We'll make our judgments. But for right now, as you said, wait and see for the Fed.
And just really quickly, Warsh, right? He was just nominated. What are you hearing? Are people liking this? Are they concerned about independence?
I think that Wall Street likes it. I think that people feel that he has enough of an institutional background. As we said, he served from 2006 to 2011, that he doesn't want to tank the economy and see that inflation takes off. But in the end, I think he is a guy who will be responsible. We hope for that because we need the Fed to be responsible to foster economic growth and contain inflation.
It sounds like we're talking to similar people because that's what I'm hearing as well. That, maybe in the future interest rates goes down in the short term, but that he's someone that would be credible, they hope, for the long term.
Indeed.
All right, Jill, so good to chat with you.
Always. Two financial nerds hanging out.
All right, thank you so much.
Do you need help paying for college? I got a 3-year-old. I'm thinking about it every day, and that's what we're talking about in today's Money Watch. College acceptance letters are rolling in for the class of 2030, and the total cost of attendance keeps rising. The average cost for a 4-year in-state student is more than $27,000 a year. And get this, it's more than $45,000 a year for an out-of-state student. CBS News business analyst Jill Schlesinger joins us. Good morning, Jill.
Good morning.
So what is the #1 tip for students trying to get a better financial aid package?
I know you think you're going to be able to work mathematical whiz kid stuff, but it is simple. Ask for more. Have I got a story for you? Someone on our staff had a child going to college, and they get their, $66,000 for the tuition, and they get their award, and it's 11 grand. They go back to the school and they say, "Hey, can you do better?" And guess what? School comes back and then gets another $15,000. Okay. They say, "All right, very nice, great." They don't accept. They don't decline. They say, "Let me go and we're going to see what else we got." School comes back again without their prompting because they want the kid. $30,000 additionally. Out of the $66,000, they get 56 covered. It was originally 11. If you don't ask, you do not get.
Yes, you don't get. That's good to know. What do you recommend for people that are starting to think you've just had a baby or your baby's 3 to start saving for college?
Right now, I think the best plan is still the Section 529 plan.
Yeah.
The money that goes in, it grows without any taxation. When your kid goes to school later, you pull the money out, and there's no tax due on all that earnings, all of that growth. Now, that doesn't mean you shouldn't take the $1,000 from the new Trump accounts. Obviously, you're entitled to it if you had a baby last year or this year or the next 2 years.
So you can do both.
So you can do both. But if you really want to make a difference in your kids saving for college, that 529 plan is powerful. Some states actually give you a state tax deduction for it. So really be careful about which state you're choosing. Check your state of residence first.
All right, so
go ahead.
Go ahead, Vlad.
So what are some good resources for families?
Well, we always see resources out there. I think that the first thing, the #1 resource I would say is your family, because you need to have conversations with your kids freshman year.
Right.
And then you can start talking about how much you can afford. And there's College Scorecard and there's College Navigator. But what this means is an intergenerational conversation that is honest. Gang, don't tell your kids they can go wherever they want. They may not be able to. Did you see those prices? 25, 30, 45. As a family, determine what you can afford. Communicate with your kid as early as your freshman year in high school.
Communication is key.
And always is.
In all things.
That's right. All right, Jill Schlesinger, thank you.
In today's Money Watch, we're talking about spring cleaning. According to CBS News business analyst Jill Schlesinger, spring cleaning isn't just about putting away your winter coats or organizing your junk drawer, something I haven't done. It's also a great time to clear out your financial clutter so you can focus on your important financial goals. And I'm happy to say Jill joins us this morning. All right, this is definitely something that I need to do. So it's tax season. What do we need to do in terms of storing the documents? That always feels like the big hurdle for me.
Yeah, I think that there are people who might have some returns from the 90s floating around. You don't need to keep them that long. But because of the way the IRS works, they can audit you, right, for just weird things that happen, right? And if they're in an audit, they usually can go back 3 years. But if they find a substantial error, they can tack on another 3 years, which means that you and I, all of us, should be keeping our tax returns and all of the supporting documentation for 6 years. Now, if you do have older returns, don't worry about it. Fire up the shredder. Get all that stuff shredded. The reason why I say shredding is that there's so much personal information on your tax returns. You do not want to just throw this out. Please, even if you don't have a shredder yourself, a lot of workplaces have shredders. So avail yourself to the shredder, more than 6 years, and all that documentation right into the shredder.
My mom has a shredder, so I'll be coming home with all my tax documents.
Perfect.
All right, so 6 years, save it. What about bank statements? What do we need to do in terms of that?
I think that the general rule is when you have a bank or an investment statement, if you think you're going to need something for the subsequent tax year, hang on to it. You can print out. I mean, again, if you get it electronically, great. But if you need that statement, maybe because it says something on that, maybe you gave some money to somebody and you want to claim it next year, print it out, throw it in your tax file. But generally speaking, more than 12 months old, you can shred that or delete it. Most banks, most financial institutions have those statements available for at least 12 months online. And if you want to request an older one, they'll certainly comply with you. But if you think you're going to need it, tax purpose-wise, pop it out. One big caveat. You ready?
All right, I'm ready.
If you or someone in your family thinks they might be claiming a Medicaid claim, right? Then you have to keep those statements for 5 years. Many states look back for 5 years to see what was in your bank and investment accounts to see if they will process that claim and allow you to claim for Medicaid. Again, like this happens often with a nursing home. Dad's going into a nursing home. Move some money around. They're looking back 5 years. So keep your statements for 5 years.
That's really helpful because also even for folks that maybe aren't there yet, it might be in a year or two. So always have that in the back of your mind. Otherwise, 12 months is good.
Exactly.
I'm the person that whenever I move, there's this box of documents that I'm like, oh, I need to keep these forever. And it just moves with me from place to place. So what should I keep in there that I can just never throw away?
Birth certificate, death certificate, social security card. Please do not carry your social security card with you. That is a no-no. Marriage license, a divorce decree. It can be often a necessary component of a second marriage is finding that divorce decree. Military discharge papers, and of course, all of your estate documents. Now, the best thing to do with all of these documents is to digitize them. Even if you have the hard copy, digitize them, please, and keep them in the cloud. Otherwise, the physical can be in a fireproof safe. It could be in a safe deposit box. But when in doubt, if you really are worried, sure, keep it and check in. But those are generally the items you need to keep forever.
The marriage certificate one, I've had to pull that out more than I would have expected over the past couple of years. To know where that is very important. You've also said, I mean, technology makes it easy to open accounts these days. Is this a good time to sort of set, reset, check things?
Yeah, generally speaking, I love this time of year to just say, hey, are there old retirement accounts? Can I combine things? Consolidating your accounts, retirement accounts especially, makes it a lot easier to manage and often can reduce the cost. So consolidation where possible.
News you can use. That's why I love talking to you. I'm always like, okay, all right, I gotta check this, I gotta check this. Jill Schlesinger, thank you so much for joining us.
We're now in the busiest season for the housing market, but there's a lot of anxiety due to the recent spike in mortgage rates and concerns about the economy. So if you are a buyer or a seller, how can you navigate your way through the uncertainty? CBS News business analyst Jill Schlesinger is here with what you need to know. You are the best person to help us navigate things. Aye, aye, Captain. So, Jill, what is happening with the housing market right now that people should really understand?
The beginning of the year, there was a lot of optimism. We talked about mortgage interest rates going below 6%, and that was exciting. We heard a lot of stories about listings increasing, so it was really kind of a positive feel. However, with mortgage rates moving back up, and with anxiety around the war, I think a lot of people get nervous about a big decision. A lot of folks are saying, you know what, I'll hang out, I'll stay in my house, I'll make it nicer, but I just don't want to make the plunge in buying another home.
I want to make it nice. I want to make it nice, as the Real Housewife said. I try to make it nice. So, Dorinda, but what do you think are if you're going to make it nice, what do you think are the improvements that pay off the best?
Well, it's so
the bathroom, the kitchen.
So let's just talk about the ones. This is a great survey. It's like, where do you get the best bang for your buck? When you put the money in and then you sell your house years later, where do you get that money back? When do you recoup? It is very unsexy. I am so sorry. I am talking about a garage door, a front door. I'm not kidding you. Siding.
No, I want that new backsplash.
Okay, I get it. But some of those projects, you know, when you think about it, even in the world of like tons of crazy weather events, a generator, these are things that actually make a lot of money back for people. But let's switch to the kitchen conversation because backslash queen over here wants to put her back. Okay.
I have
There's a real issue around kitchens because if you look at the 3 different levels, a low range, a mid range, and a high-end redo, just look at these numbers. Minor repairs. Oh, you throw some cabinets on, you do a little bit of an upgrade, you get a lot of your money back. More than 100% of your money comes back. The mid-level, forget about it. You're getting about 60% back, and you want that high-end fancy range and your fancy appliances. I just want to be clear that when you think about that high-end kitchen, you're not getting your money back. It's nice for you. It's great. With a bathroom, just make sure one very important thing.
The toilet.
A toilet is good, a sink is good. But
I was going to say thank you for validating what I've been saying
yeah.
for years.
Okay.
I don't need to do anything. It's fine. The water runs.
Bathroom, if you have one bathroom and you're a 3-bedroom house, you really do need another bathroom. Instead of fritzing up your one bathroom, put a second bathroom in. Living space is great.
Yes.
Thank you very much, Jill Schlesinger. We appreciate it.
We are talking about love and money. So listen to this. According to a recent survey, 45% of Americans who are in committed relationships believe they do not know everything about their partner's finances. 38% think financial infidelity is just as bad as physical cheating, with 5% thinking it's worse. CBS business analyst Jill Schlesinger is here with more. Jill, good morning.
Oh, it's a hot topic, isn't it?
I know. Okay, so there really is nothing romantic, in my opinion, about talking about money with your partner. You might disagree, but why is it so important and how should we do it?
You know, first of all, you're not going to do it today. We're not talking about this on a Valentine's weekend. Please don't do that.
I know people who do their taxes
on
Valentine's Day. That's what they talk about.
No, that's wrong. That's just wrong. I mean, listen. I think the real issue is that we're trying to demystify your financial life. And we all bring into our relationships a little baggage. So what we're trying to do is get on the same page. One of the best ways you can do that is to set aside some time, not on Valentine's Day weekend, and talk about your various financial life aspects. So what are we talking about? We're talking about saying you're building your balance sheet, what you own and what you owe. This is where you are bringing together your total lives. You are finally disclosing that secret credit card that you may be a little bit stuck into the back of the closet there. And I think it's important to do this because if you are going to try to reach certain goals, we want to buy a house, we want to retire, we want to send our kids to college. If you don't know the full picture, how are you going to get there?
So most couples have at least some money that they have separately, right? But 38% of couples keep funds all in joint accounts. When do you know when it's best to have split accounts or joint?
There's no rule of thumb. The most important thing is that you are disclosing all the accounts and that you are actually making sure that the system works for you. Let me give you an example. If there are two working people who marry later in life, you have your own systems. It's okay. You can manage your own money. You might say we have a joint account for the household expenses. Whatever system you use, if it works for you, it's great. I'm not one of these people who's going to tell you, keep all your money together, keep all your money separate. It doesn't matter. It's what works for you, but do share the information. Again, why is the sharing so important? Because even if you're the one who's like, I hate doing money, you have to be informed. If something happened to your spouse and you didn't know where the bill-paying system was, what the investments are, what the passwords are, you are flying blind. It's a terrible way to proceed in your life.
So like we mentioned earlier, 38% of Americans think that financial infidelity is just as bad as physical infidelity. Is it really that bad? And what are the red flags?
Okay. Well, there are some red flags, which is that I'll start with the red flags, because I actually spoke to a forensic accountant about this. Yeah, I know there are people who do this. The reason why it's bad is that you really are bringing together two lives when you get married. You bring your financial lives together. And so, you know, honestly, if you're lying about that, what else are you lying about? That's the problem. The other piece is that
there's a difference between lying and not. And, like, maybe you just don't think it's relevant, but go on.
Okay.
This is not me.
Asking
I have
for a
told,
friend.
My husband knows everything.
Okay, but the reason it's a problem is that what if one partner's bad behavior or a secret account is derailing the ability to make progress? I really think that that's the issue here. So some red flags. ATM withdrawals that are unaccounted for. If all of a sudden you're doing your taxes this tax season and a document comes in, there's a bank statement you don't know about, that's something that you would want to know. Or a credit card. If remember, you are joining yourselves financially, this is an important thing. Disclose, share, get on the same page.
Yeah, because love and marriage, everything's shared, including debt.
You betcha.
Jill Schlesinger, on that note, thank you so much. In today's Money Watch, we are answering your money questions. Well, not we, that's a bit generous. I'm more talking about CBS News business analyst Jill Schlesinger, who, of course, is a certified financial planner and regularly gives advice on her wonderful Jill on Money radio show. And it's a podcast, which I love. And today we are so lucky to have Jill here to answer some of your financial questions. Okay, so I have a list of people who wrote.
All right.
Lisa from North Carolina asks, I'm trying to grow funds for a future down payment for a condo. It'll probably take me about 5 to 7 years. So I was investing in stocks and bonds, but with the wacky market, and it is wacky, should I use CDs instead?
This is funny. Are you sure this is not you? Lisa, are you Adriana? Okay. So a lot of people are worried about this. I think that's very critical to hone in on that time horizon. 5 to 7 years, that's not 1 to 2 years, right? If it's 1 to 2 years, then yes, of course, I'll say take a seat, relax, get some CDs, keep your money safe.
Okay.
But once you're talking about 5 to 7 years, I think you can actually do more of a balanced portfolio where you don't have too much risk and keep that money invested. As you get within that, say, 18-month period, that's when you're going to dial back the risk, keep that money safe, and get ready to buy your future home.
The American dream. All right, we have a question from Chelsea from Maryland. She says, I'm 36 years old. My employer just announced that they would now be offering a Roth 401k option starting this year. If I switch from the traditional to the Roth, will I see a big change in my paycheck?
Well, I mean, you're going to see a change because remember, the difference between Roth and traditional is really about when the money is taxed. When you use a traditional account, the money comes off the top of your pay, goes into the account. The money grows without taxes. Later on in retirement, you take it out. That's when you pay the tax. With a Roth, you pay the tax today. Then the money goes into the account. The money grows over all those decades. You take the money out, no tax due. So here's what's important about this particular situation. When you're younger, Roths make a ton of sense. I mean, I love the Roth anyway. You're paying the tax at what is probably going to be a lower tax bracket when you're in your 20s than later on. And even with people who are in higher tax brackets, a lot of the research finds, hey, you know what? Those Roth dollars, they grow really fast. And because there's no tax due at the end, it really helps manage your retirement income.
And should you only go with a Roth after you've tapped out and maxed out your regular traditional 401k?
No, because what's happening now is companies are saying we're offering a Roth 401k. Now, there are some companies that will say we'll only match your contribution into a traditional. Right. You can't control what they do. You can control what you do. In general, if you're young, you've got many years to go. If you're in a lower tax bracket, 22, 24 or lower, then absolutely the Roth is the more powerful retirement savings tool.
All right, we're going to stay with retirements. Nancy from Chicago asks, I'm 64 on the verge of retirement, and most of my money is in a pre-tax 401k. What should I do with this account when I retire?
Oh, this is a great question, because once you retire, there are usually 3 options. One is that many companies and many organizations say, hey, keep your money here. This can be really helpful if you're used to the platform, if you know what the investment options are. It can be really helpful to just say, stay where I am, no problem. The second option would be you would say, I'm going to roll that money over into a new retirement account, an IRA rollover account. Now, in retirement, she may think, oh, I'll just take the money out. Don't do that because you're going to get taxed on the money. So roll it over into an IRA rollover account. Now, if you are someone who's not retiring but you have a new job, you could also potentially take old money from an old employer and roll it into your new plan. So 3 basic choices. Leave it where it is, roll it over, move to the new plan.
Love that. It's a good question to have from our friend in Chicago. Jill Schlesinger, thank you so much. In today's Money Watch, we are answering your money questions. Well, maybe not we, more like CBS News business analyst Jill Schlesinger, who is a certified financial planner and regularly gives advice on her amazing podcast, Jill on Money, and her radio show. Jill, welcome.
Hello.
Okay, long list. Let's get to it.
Let's do it.
So the first question comes from actually one of our staff members who we promised to keep anonymous, and we will. I actually have no idea who it is. The question is it okay to cancel credit cards, or should it be avoided at all costs?
Okay, here's the thing with credit. It is a weird compilation of information. So here is how a FICO credit score is actually calculated. There's a part of it that's just your payment history. It's the amount of credit that's available. It's how long you've had it open. And what's interesting is when you cancel a credit card, it's actually a negative impact on your score. So let's say you're done, you've paid off this credit card, you're not going to use it anymore. As long as there's no fee attached to that card, stick it into the back of the drawer, stop using it. Don't cancel it because it negatively impacts your credit score.
Follow up to that, when you get married, does your partner's credit score affect yours?
Well, each of us has our own credit score. The only way that your partner or your spouse's credit is impacted by yours is if you're applying for credit together. The most common pathway is we apply for a mortgage together. Now, let's say your partner is a bust out, terrible credit, you're fabulous, Tony. And if that's the case, when you apply together, the good person's score can help boost the person who has a lower score. But I really want to tell everybody, and I'm going to be very clear about this, please avoid applying for credit cards together because you don't need to do that. You can have another sign, you can have approval for someone to do it, but someone's bad credit score can drag your good credit score down, and then when you need it, it's bad for both of you.
Oh, good advice. All right, so Ken from Pennsylvania wants to know, what are the advantages or the disadvantages to keeping income and expenses separate in a marriage? Seems like a lot of meaningless paperwork.
Yeah, I mean, this is really up to you. It is very clear to me that there are some couples where pushing it all together, having one person manage the bill paying and managing the process really does make sense. But if you're going to do that, please communicate your system to the non-involved spouse. Now, if you want to keep things separate, that's okay too. People get married later, you've got your own lives, but you want to have probably one account where there is a repository for your joint bills. But you want to keep it separate? Fine, no big deal. Keep good records, keep the communication lines open.
I want to talk about Veronica from California. She's 40, has a new job, and she has a 401k question. Pre-tax option and Roth option. What's the difference? What do you recommend?
Okay, so when you have a 401k, a 403b, any job-related retirement plan, there are two options that are available usually. One is a traditional 401k, 403b. That's pre-tax. What happens with that is money comes into your account, and it's basically not taxed yet. So if I say I'm putting $10 into this 401k, that $10 goes in, no tax that's due. When I take the money out later in life, after 59 and a half, whatever tax bracket I'm in at that time, that's when the tax is due. With a Roth, you pay the tax on that $10 today. The money goes into the account. It grows, it grows, it grows. You take the money out later, no tax due. For younger people especially, I love the Roth. Roth retirement plans actually help you really understand what your future tax liability is. So all Roth all the time, especially if you're under 40.
Hey, if you could do it quickly, I'm really interested in Shannon from New York asking, how much money should someone have in savings when thinking about having a child?
An unlimited amount, obviously. You guys would know that. We generally say you should try to have 6 months of an emergency reserve. If you're going to have a kid, let's try to get that to 9 months. But look at these expenses. Gang, something around $12,000 to $15,000 in the first year on things for like diapers and car seats. So I hate baby showers. I am allergic to them, but I think you should have a baby shower and get all of your friends and family to pay for as much of this stuff in advance. And if you invite me, I will send you a check and not arrive. So that's how I roll.
I was just going to say, if I have another one, you're coming.
Yeah, you betcha. I'm not coming, but I'll definitely send you the money.
Or you'll host it in your beautiful house.
Oh, gosh.
You love kids.
I do love kids, but I really love the four-legged ones, which they don't need diapers.
I'll bring a diaper cake. Jill Schlesinger, thank you so much. We are diving into the subject of life insurance. It is very exciting, very important. So let's continue on. It is never easy to think about topics involving loss, but listen to this. 40% of adults say their loved ones would not be financially secure after the death of a primary wage earner. And 47% would have trouble paying their living expenses just within 6 months. Don't worry, we have help. CBS News business analyst Jill Schlesinger is here to explain what you need to know about life insurance. Jill, thank you for being here. So tell us how life insurance works, just to start out.
Right, very easy. You pay a company a certain amount of money every year. That's a premium. And if you pass away, then that company will pay a stated amount of money to your beneficiary. And as you said, that this can be meant to cover lots of different things. So, your living expenses, but also perhaps you're the kind of person like, I'm the primary wage earner. If I pass away, I want to put money away for my partner or my spouse's future retirement. Maybe I want to put money away for college. So it can cover not just living expenses in the event of loss, but also other future goals.
I hadn't thought about that. College, that's so true. So almost a quarter of Americans say they have not purchased life insurance because they don't know what type they need. What are the different types?
Well, let's make it easy. There are basically two different kinds of insurance. One is called term. You buy the insurance for a specific period of time. So you might say, hey, I'm Adriana. I'm young. I only need this for 20 years. Over the course of 20 years, I will basically be able to save a bunch of money, and my kids will get older, so my need will go down.
Oh, the 20 years is because my kids will be grown.
Right, and so that...
I was like, in 20 years, I'm more likely to not be here.
So term coverage is really affordable, especially if you're young and you're healthy, and it's great, especially for families. It's really the best way. I would say 95% of the time, term will work. Now, the other kind of insurance is called permanent. It stays in place permanently. So you may have heard of something called whole life, universal life, variable universal life. But very few people have a need for insurance coverage for their entire lives. The people who do usually need it might need it to, say, fund a special needs trust. They have a special needs child. They got to put money away. Or maybe it's for estate purposes for when you pass away. There's some extra money floating around the estate to pay taxes.
So you say if you're healthy, that also brings down costs. Do you need to go to the doctor in order to get life insurance? Like, how do they know how healthy you are?
So it depends how much you're getting. But for many of the online coverage policies, you can get usually $1 million of coverage without going to get a medical exam. But if you're getting a lot of coverage, they're often going to send their own person in to give you a medical exam.
Oh, really?
Yeah, they want to make sure that you really don't smoke. Or
you want to check the engine.
Yeah, they kind of do.
So what factors should you think about when thinking about how much to get?
Well, first of all, there's a ton of calculators that will help you do this online. But again, it's the day-to-day expenses. So knowing how much you spend right now is an important part of this. But also, maybe you've got other coverage. Maybe you've got money through that's set aside in insurance through work. Maybe you want to fund something in the future. And of course, at the very end of the day, you know, the easiest way to calculate this is to use a calculator. But I round up. Insurance coverage is pretty cheap if you're young and healthy.
Okay. I've seen that coverage offered through our workplace, benefits. A lot of people have that. They can get life insurance through work. Should they?
I think it's great to do it. It's usually affordable to do a group rate. But the thing is that you want to make sure it's portable, meaning you can take it with you when you leave. So a lot of people might say, oh, I got 5 times coverage. You can buy more coverage. You can buy it for you and your spouse. It's great. It's affordable. But if you can't take it with you, what happens if you switch jobs?
Right.
So just factor that in.
So much knowledge always with Jill Schlesinger. I love these. I love our chats that we have with just us and all of you guys. So if you have a question about your financial life, you can email Jill directly at askjill@cbs.com. She could answer your question in an upcoming segment. And you can hear more advice on her podcast, Money Watch with Jill Schlesinger. I subscribe to it. New episodes drop every Saturday and Sunday.